Gold is rising. Silver is rising even faster. On the surface, this doesn't sound alarming. These are safe haven assets. They move when investors feel uneasy. But what's happening now feels different. This isn't a short-term spike, it's not panic buying, and it's not being driven by headlines alone. Quietly, and without much attention, money has been moving out of promises and into something physical. Not because people expect profits, but because they're preparing for uncertainty. And historically, when gold and silver start behaving like this, they're not reacting to a crisis, they're anticipating one. To understand why, we need to look at how these metals behave when confidence in the system starts to crack, even before most people notice. For decades, gold and silver have played a very specific role in the global economy. They aren't growth assets, they don't generate income, and they don't depend on innovation or productivity. Their value comes from trust, or more accurately, from what happens when trust begins to fade elsewhere. Traditionally, investors turn to gold during inflation scares, market crashes, or geopolitical shocks. Silver often follows, pulled along by both fear and industrial demand. When confidence returns, money flows back into stocks, bonds, and risk. That's how the cycle usually works. And for a long time, that pattern held. Even during financial stress, gold and silver moved in short bursts. They reacted, then they settled down. But this time, the behavior doesn't match the script. Markets aren't collapsing, unemployment numbers aren't exploding. There's no single event dominating headlines, yet gold keeps climbing. And silver isn't just following, it's accelerating. That raises an uncomfortable question. If investors aren't reacting to chaos, what are they preparing for? Because when safe haven assets move before fear becomes obvious, it usually means something deeper is shifting beneath the surface. Gold didn't suddenly spike overnight, and silver didn't explode on a single headline. Instead, the move began quietly, almost politely, the kind of price action most people ignore because it doesn't feel urgent. At first, it looked like a routine hedge against inflation, the sort of cautious positioning investors make when interest rates stay high and uncertainty lingers in the background. But as weeks turned into months, something changed. Gold didn't pull back the way it usually does. Silver didn't cool off after early gains. Instead, both metals kept climbing, even as stocks remained relatively stable, and economic data continued to send mixed but manageable signals. Under normal conditions, that combination doesn't last. One side usually gives way. This time, it didn't. Behind the scenes, the buyers weren't who most people expected. This wasn't driven by retail investors chasing headlines or social media hype. Central banks were quietly increasing their gold reserves, not as a short-term trade, but as a strategic move. These institutions don't act on emotion. They prepare years in advance, often responding to risks long before those risks show up in public data. At the same time, silver was being pulled in two directions at once. On one side, it remained a monetary metal, benefiting from the same loss of confidence pushing investors toward gold. On the other, it was facing growing industrial demand tied to energy infrastructure, technology, and manufacturing. Supply tightened, inventories thinned, and the market began to realize that silver wasn't as abundant as it once appeared on paper. What made this phase unsettling wasn't just the price increase. It was the coordination of signals. Gold was behaving like trust was eroding. Silver was behaving like real-world pressure was building. And both were moving without the kind of panic that usually accompanies crisis-driven rallies. Historically, this is the stage people dismiss. There's no crash yet, no emergency, no clear villain to point to. But it's also the stage where capital quietly relocates, where institutions adjust exposure, and where the smart money stops asking if something might go wrong and starts planning for what happens if it does. Because when precious metals rise together, steadily and without drama, they're not responding to fear in the headlines. They're responding to stress inside the system. Stress that hasn't fully revealed itself yet. This is usually the moment when markets give people an excuse to relax. A pullback, a correction, something that suggests the move was overextended. But that never really came. Instead, gold held its gains, silver pushed higher, and the behavior began to resemble patterns that don't show up during healthy cycles. Historically, precious metals don't just reflect fear, they reflect confidence, or the lack of it. When investors believe the system will hold, money stays productive. It takes risk, it chases yield. But when that belief weakens, even slightly, capital starts asking a different question. Not how much can I make, but how much can I protect? That shift is subtle, and it rarely makes headlines. What makes this phase uncomfortable is that gold and silver tend to move before the reasons become obvious. In past cycles, they didn't wait for recessions to be announced or for crises to be officially recognized. They moved ahead of currency stress, ahead of credit problems, and ahead of moments when confidence finally broke in public. Silver's role here matters more than most people realize. Unlike gold, silver is tied directly to the real economy. It's used, consumed, and depleted. When silver begins outperforming alongside gold, it suggests pressure on both sides of the system, trust in money and strain in production. That combination doesn't appear often, and when it does, it tends to precede periods of adjustment rather than stability. At the same time, currencies began sending quieter signals of their own. Purchasing power continued to erode, not explosively, but persistently. Debt levels expanded without meaningful resolution. Governments reassured markets. However, reassurance has limits when the underlying math doesn't change. None of this felt urgent on its own, but together, it formed a pattern that markets are trained to recognize. What's important here is not panic, but positioning. Institutions don't wait for confirmation. By the time a crisis is obvious, protection is already expensive. So instead, they respond to probabilities. They hedge against outcomes. And when gold and silver rise together in a controlled, sustained way, it often reflects preparation rather than reaction. This is the part of the story most people miss. Because nothing has collapsed yet, it's easy to dismiss these movements as noise or speculation. But markets don't move on headlines alone, they move on expectations. And right now, expectations appear to be shifting in a direction that suggests discomfort with the path ahead. Not certainty, not disaster, but doubt. And historically, doubt is where major transitions begin. What makes this story urgent is not the price of gold or silver alone, but what drives those prices. The movement is being fueled by forces that rarely make the front page. Central banks are quietly adjusting reserves, reducing reliance on traditional currencies, and hedging against systems that they no longer fully trust. Governments are expanding debt quietly, issuing bonds and credit at levels that would have raised eyebrows just a few years ago. Meanwhile, geopolitical tensions, trade disputes, shifting alliances, and fragile supply chains add pressure that cannot be captured in a stock chart or headline. Silver, in particular, tells a dual story. Its industrial demand is climbing alongside technological growth, while its monetary role signals systemic caution. Unlike gold, which is almost purely symbolic in times of stress, silver reacts to real-world scarcity and consumption, meaning the economy is facing pressure from both sides at once. Rising silver prices hint that while markets may appear stable, the underlying structures, production, credit, and supply are quietly straining. All of these forces together create a subtle but significant warning. When precious metals move in a controlled, sustained way without visible panic, it usually means that institutions and informed investors are anticipating a shift that the broader public has yet to recognize. Markets, after all, respond to probabilities long before they respond to reality. And right now, probabilities are signaling caution, not complacency. The question is not whether gold or silver will fall tomorrow, and it's not about predicting headlines. The real story lies in what these signals reveal about confidence, stability, and preparedness. If trust in fiat currency wavers even slightly, if debt and obligations strain under pressure, then the protective moves we see in precious metals today may be the first echoes of broader structural adjustments tomorrow. For individuals, this might mean reconsidering exposure, but more importantly, it's a lesson about paying attention to subtle signals, about recognizing patterns before they become crises. For governments and institutions, it highlights the need for vigilance, transparency, and planning. And for everyone watching, it's a reminder that markets do not wait for permission to reflect reality. They move first, and those who notice first are often the ones best prepared. Gold and silver are not screaming, and they are not panicking, but they are speaking. They are signaling caution, tension, and the quiet anticipation of a world that may be more fragile than it seems. The metals themselves do not create crises. They merely reveal the cracks that already exist, and in their rise, they ask us a simple, uneasy question. If the system's vulnerabilities are already being signaled, are we paying attention before it's too late?